it's not that you nailed the bull market like Yardeni or Akampora, but you said there's this wall of money out there. How does that wall of money in your acclaimed essay, how does it fold into how to listen when markets speak?
Well, Tom, you think about passive investing, right? And Jack Bogle's up in heaven, God bless him. But, the Vanguard origination of passive investing. It started with the best of intentions. The best of intentions. But at some point, passive becomes a little bit more evil because there's 35 trillion, at least 35 trillion tied to the index, the S&P. And so when you have a stock like NVIDIA that's now become 5% of the S&P 500, 5%, and it's trading 80% above its 200-day moving average. Meanwhile, the energy sector as a whole is only 3% of the S&P. And so what happens is at some point, too much money is in passive investing. There's not a lot of thinking behind that, and it gets very crowded and what we call herdy. In other words,
right,
like a herd, and it creates more distortions on the upside, and it'll create more distortions on the downside.
Okay, somebody like Cliff Asness, who's smarter than me, they're basically apoplectic about the interior dynamics of the market. Years ago at Lehman, this is what you did. And my answer is, when you wake up in the morning, what does Larry McDonald apply from how to listen when markets speak over, I just want to get to the end of 2024? What's the dynamic you're using right now, Larry, to analyze this market?
Well, as a former Lehman trader, our first book was a New York Times bestseller, and it's done pretty well. It's in about 12 languages. But I tell my wife once a month, Tom, if we sell 1 million books, we'll break even on our Lehman stock, right? So, in other words, it's been a long road. But the lesson from this book is that the Lehman collapse, the response to that was a 4 trillion fiscal and monetary response. 4 trillion. The response to COVID so far has been all in about 16 trillion fiscal and monetary response. So everybody's in a 2010 to 2020 portfolio. In other words, everybody's in that kind of disinflation regime portfolio, which includes a lot of growth stocks. It doesn't include any hard assets. It's all financial assets. There's 22 trillion, Tom, in the NASDAQ 100, 22 trillion. And there's very little money in real hard assets, Bitcoin overall. Most of the money is in what we call financial assets. It's bonds and growth stocks. But in an inflationary regime that is sustainable, and that might just happen after a 16 trillion fiscal and monetary response, you probably need an entirely different portfolio. A 2020 to 2030 portfolio is going to look a lot different, Tom, than a 2010 to 2020 portfolio.
Here.
Exactly. Hey, so, Larry, the book is entitled How to Listen When Markets Speak. Boy, what are the markets telling us right now?
Well, right now we have a tremendous amount of capital that's moved into certain spots, and volatility is low. And there are opportunities really in, if you look at not just gold and silver, but look at aluminum, look at Alcoa. Alcoa equity is moving, I think about 60, 70% off the lows, right? And that's since the fourth quarter. And you've got oil and gas companies making new highs in the XLE. So I think what's happened, what the market's telling us is that there's a migration of capital that's starting. Capital is moving from financial assets into hard assets. And if Powell is truly on this dovish crusade, in an election year, has to lean a little bit dovish relative to where inflation is, then I think the market's telling us that you want to start moving into your aluminums, your coppers, and your hard asset equities.
So, Larry, I mean, I guess, a lot of folks were sitting here and we're looking at the S&P 500. Let's just take that. From October, we're up 25% here. Is the market ahead of itself here? Do we need to get a little bit more cautious here?
Well, as a whole, the index, what we argue in the book is everybody's 401k in the United States has been hijacked by about 12 companies. And everybody knows that. And it's nice when it's rolling along, but it's more like it's more like we're heading toward a transition. I think the market's clearly overvalued relative to, in a sustained inflation regime. And a sustained inflation regime is going to put on a lot of challenges to high valuations, and it's going to also move money into different spots. But yeah, I mean, I would be very cautious here relative to, when the street's falling all over themselves to upgrade stocks, you typically want to take some equity off the table.